On behalf of the organizing committee, I want to thank everyone for joining us today. In this series, each session is hosted by a different institutional partner. Today's host is the ECB, and I will now turn things over to our moderator today, Katrin Assenmacher.
Thank you, Jonathan. So I'm Katrin Assenmacher. I'm head of the division of the Monetary Policy Strategy Division at the ECB, and I'm very pleased to chair today's seminar with Martin. So let me first start with a few housekeeping notes. So the presenter has been allotted 25 minutes, and then there will be a discussion of 10 minutes. And then there will be a Q&A with the floor and the panelists of about 20 minutes. During the Q&A session, the panelists can unmute themselves and ask questions or make comments. The other attendees, please use the Q&A area to ask questions. I will then select questions from the Q&A box and ask either the presenter or the discussant to answer them. Please also note that this conference is being recorded and the video will be posted on our website. Let me now introduce Martin. Martin is professor at Stanford University, and he has published many papers in top economic journals. And I have looked at his publications, and I found that he has worked on every hot topic in monetary economics. So starting from housing, going to interest rate and credit risks, the effect of collateral, heterogeneous beliefs, distributional effects of monetary policy. So it's probably no surprise that he also has a paper on central bank digital currency. And today he will present the paper on credit lines, bank deposits, or central bank digital currency, competition, efficiency, and modern payment systems. So Martin, the floor is yours. Please share your presentation, and we are very much looking forward to your talk.
Well, thanks very much, Katrin, for the kind words. And thanks a lot to the organizers, first for putting together this very nice series, and then for having us. This is joint work with Monica Piazzesi, who's also here, so you could ask questions in the chat that she can reply to while I'm speaking. This is a paper on motivated by the discussion of central bank digital currency, where there is a rapidly growing literature with different concepts of CBDC. In this talk, I'm going to focus on the concept of interest-bearing reserves account for everyone that would compete with bank deposits. And our angle on this is that we want to say this is something that comes into the market for liquidity, where the other products are not only bank deposits, but also credit lines supplied by commercial banks. And just to give a rough idea of importance, this is deposits and credit card limits at US commercial banks over the last decades. And the idea is credit cards are an important means of payment. This is mostly household credit cards, and so this does not include all of the credit arrangements that banks have for liquidity purposes with, say, asset managers and firms, which would make this number even more important. So the argument is going to be that commercial banks add value by providing liquidity. And to do that, they exploit a complementarity between bank deposits and credit lines. Now, if you add a CBDC, the way the usual proposals work, these will not be complementary to credit lines, and therefore going to be beneficial only if they're much cheaper to produce than deposits. And this argument is going to rely on an externality among different liquidity providers. So it's going to help also think about stable coins and money market funds, which are sort of other intermediaries that only do deposits and not credit lines, and so do not exhibit this complementarity. Now, we add to exciting and growing literature of just theoretical studies of CBDC that have asked under what are the conditions when the CBDC doesn't really change anything or it changes various things. The new element in our analysis is studying the interaction with credit lines. And therefore, we also relate to a large corporate finance literature on the role of credit lines that has in particular used this idea that when liquidity needs are hard to predict, then a credit line can be a very useful instrument. This is what's going to be in our model as well. This complementarity of deposits and loans, loans for liquidity purpose at the individual bank level has been pointed out in the literature and studied empirically. And this is going to be central in our analysis, which of course is going to be about general equilibrium and the interaction of these different types of intermediaries. Okay, so let me go straight into the model. So this is going to be basically a neoclassical growth model with some liquidity shocks and frictions that people then need to navigate. So we're going to have a continuum of households who work and consume goods. And every period, there's going to be a fraction VC of households that consume, whereas everybody works. Okay? And then when I have a preference shock, that's going to select the guys who work. Preferences were represented using a discount factor beta, and then a utility from consumption goods and labor, which is standard balanced growth type. And aggregate consumption is going to be the sum over all these people. We're then going to have a continuum of competitive firms, and those are going to come in two flavors. There's consumption good producers that use capital and labor to make the consumption goods. And there's capital goods producers that use the consumption goods one for one to make the capital. And here, we're also going to have these liquidity shocks. We're going to say that there's some fraction VI selected by an IID productivity shock chi. And that tells the person whether they can produce or not, okay? And the reason for having that is to have this additional need for liquidity in the accumulation of capital. And we think of this as broadly a stand-in for asset management, portfolio rebalancing, things like that, where also liquidity is needed. And now, so it's all neoclassical growth model except for these shocks. And then we're going to have these parameters V that are going to be central, going to describe the predictability of the liquidity needs in the economy. If V was equal to 1, then everybody always knows that they're going to consume or produce, and that makes life easier than if it is not known. Okay, so why are these liquidity shocks a problem? Well, we're going to have liquidity constraints, and the way we're going to build those is by saying that the time is going to move in half steps. So t minus half, t plus half. And in the non-integer periods, the households and firms trade goods, consumption, investment is purchased, and also production occurs. But then the key is that only the banks trade assets. Whereas in the integer periods, households and firms trade assets and the factors of production are paid. So you see that the role of these non-integer periods is to have some like a device to mimic decentralized exchange. So this sort of multi sort of sub-period structure is also in other model of money, in particular Lagos and Wright's model. And here it's done with these different types of periods in a growth setting. And then in order to transfer funds both in and out of these non-integer periods, the households and firms are going to have to use payment instruments. And so that's very different for buyers and sellers. So the buyers of goods here, these households and capital producers, they're going to need the payment instruments before buying. And then because the liquidity needs are unpredictable, only some share V gets a chance to buy. They got to take this into account when selecting the payment instrument. And then the sellers that are the producers of goods here are going to need the payment instruments after selling, and their liquidity needs are more predictable. They just need to store the funds until the next half period in order to pay the wages and the rents. Okay, so where do these payment instruments come from? This is going to come from banks. Banks also going to need payment instruments to meet customer outflow. So there's going to be liquidity constraints in both layers, both at the end user layer, firms and households, and at the bank level. So let me say more about the payment instruments. We're going to have competitive banks that offer two types. One is deposits, and deposits have the feature that you got to hold them before trading. Then you spend them if you need them, and otherwise you keep them and hold them again for another half period. In contrast, a credit line is something that you draw down in order to receive a loan if you need it, and otherwise you don't need it. You don't use it. We're going to quote prices per unit of liquidity provided. That's the way the pricing is going to work. And then you can think about the trade-off here in a world where these liquidity needs are hard to predict, is that if you arrange a credit line, then that avoids holding deposits that you may not need. Okay, that's going to be the key advantage of credit lines. And then there is a cost. So then we're going to see how that works. Now, we got to take a stand on how the banks are organized. So we're going to assume that equity issuance is costless for the banks as well as for the firms. And the financial frictions in the banks and firms are going to be one, for the banks, there is a collateral constraint. That is the debt, the deposits, have to be less than some value fee times the value of the assets. And this is kind of to capture the idea that payment instruments have to be safe. And then second, we're going to say that there is an asset management services kappa needed per unit of assets. And these are the goods that must be purchased at some price P. This is in order to capture the idea that any delegated asset management, be it in banks or in firms, is costly. And these are resource costs. These are not just wages, but these are resource costs. So this production of services requires capital and labor. And then you see another piece of intuition right here, which is that these firms, because they have these asset management costs, are going to like credit lines where they don't have to hold the deposits for liquidity purposes that they might not need, because this is going to have these asset management costs. Okay, now before defining equilibrium, I have to say, what are the assets that are available to the households in the integer periods where they can trade assets? And so in addition to the payment instruments, households can directly hold capital, and they can also hold bank equity. And importantly, there are contingent claims on all the preferences and productivity shocks that the households receive. And so these contingent claims are one period ahead. The shock gets realized in the half period in the middle. Okay, and so what that means is that we can then get a household sector that works like a large family that insures the members against these idiosyncratic shocks, and that owns the banks and the firms. And then we don't have to worry about the wealth distribution, even though there's all these different people that get different shocks. And so that's sort of using complete markets complete markets against with a period delay to cancel the wealth distribution as endogenous state variable, similar to what in the Lagos right setup is done by this Walrasian market where there is linear utility. Okay, so then we are going to look at symmetric competitive equilibria that consists of prices and allocations and asset positions with many identical firms and banks, maximize utility, shareholder values, and markets clear. To comment on this, so this is putting in place a very stark liquidity-centric view of banking, not because we think that's necessarily the right view, but it sort of zeroes in on what's new in this paper. And so in particular, we put sort of independence of the savings and liquidity provision features of the economy with two assumptions. One is that in this, what I've described, we're basically saying that banks are, in terms of their investing, only good at credit lines. They're actually bad at holding capital because you pay these asset management costs when you put capital in the bank, but not when you hold it outside the bank. Second, and this is an additional assumption that's in the papers, we restrict preference in technology so that capital is held by banks, that if held by banks to back payment instruments is less in equilibrium than the total capital. This means that you don't have to have, in order to provide the liquidity and back the deposits with these collateral constraints, you don't have to accumulate capital in order to provide enough liquidity instruments to make the economy work. Okay? So that means that then the size of the banking sector, which is an endogenous object in this model, is going to just reflect the demand for liquidity and not savings. These are kind of orthogonal things. Okay, second point, I've sort of talked about capital as something that households and banks invest in. But this we can interpret broadly, because in this model, Modigliani-Miller theorem and Ricardian equivalence is going to hold except for any trades that involve payment instruments. And so you could just think of the banks holding firm and government debt and not just capital. Good. Okay, so now we have the model on the table. So I can characterize equilibrium. This is relatively easy in this model, because you can basically write down a social planner problem that gets you the allocation. And that social planner problem has a special resource constraint that has liquidity costs omega on the different ingredients there: consumption, investment, and output. Of course, because we can divide by one, then in principle there's only two things that matter, but for the interpretation and for deriving it in the paper, it's helpful to split it into these three things. And so then you can kind of see how the real effects of the payment system work in this model. If you have a more costly payment system, that is equivalent to having a less efficient production technology. Okay? And then how does the allocation of the economy react to that? Well, just like it would in the neoclassical growth model. That may include effects that differ by sector. For example, if you set up the system so that it's particularly expensive to do investments, say because credit lines are particularly expensive, and then these firms that don't want to use deposits find it more expensive, then the payment system discourages investment, and there'll be less capital accumulation, etc. Okay, so that's now you can imagine. So the paper has lots of equations where we can derive these omegas for different types of systems and do comparisons. And this is what I'm going to do now in the remaining time. I'm going to show you some comparisons. This will all be steady state welfare effects for the different payment systems. I'm going to make the assumption that the liquidity needs are the same. This predictability of the liquidity needs is V, the probability that the liquidity shock shows up. That is the same for the households and the firms, the capital producing firms here. That's to simplify. And then I'll not walk through all the busy work algebra, but I will just show you some balance sheets before and after trade. That's going to give you the intuition for how the different systems work. And then it's you're going to sort of see how that's going to show up in these liquidity costs and therefore in welfare. All right. So step one, what if banks offer only deposits? So let's just assume there's no credit line. We shut that off. Well, then how does this economy have to do the trade? Well, the buyers, these households and these capital goods producers, going to have to hold some deposits because they want to purchase stuff in these intermediate periods where they can't trade assets. And the banks are going to supply that. So there's going to be a balance sheet of the bank here, where the bank is providing deposits. There is a collateral constraint, so it also needs some equity, and it holds capital in order to back the deposits. Okay. So that's how things get set up before trade. And then after trade, so trade means now V of the buyers get selected in order to buy. And so V times D money goes to the sellers. Then 1 minus V times D remains with the buyers. Those are the buyers who did not get lucky and be able to consume. And to the bank, nothing happens here because the bank just has the banking system altogether has this D on the books. Okay? So all of the trades that happen there on the books of the bank. Okay, and so then how does this translate into costs? Well, then what we can do is we can relate back the deposits to the consumption and investment desires that motivate them, right? And so in particular, if these buyers, what they need to accomplish is to provide C plus I, consumption plus investment, and they need to then hold C plus I over V, in deposits in order to make that happen. Then sort of, you can see, I think, that then now one can do the busy work and the algebra and come up with this resource constraint with these omegas, which are the liquidity costs in the equivalent planner problem. And so that gives us the properties of banking with deposits, which is that the liquidity costs are going to be relatively high if the needs for liquidity are unpredictable, if the V is relatively small. This is because you have to hold though these sort of precautionary deposit holdings, which are costly. This is especially the case for the capital goods producers who are kind of not natural savers. And I'm going to sort of just comment here that this is when I say bank, then it's always the banking system. So kind of interbank flows wash out. This is something that we've written about in different paper, but here this is the sort of interbank liquidity management is all netted out, is all identical banks because of the symmetry. Okay, good. So that with that, we can go to credit lines and how credit lines might improve life. Okay. So what happens with the credit line? Well, there's still buyers, households and capital good producers, and they know that they're going to have to trade and they're going to arrange for that. And now they're going to arrange using credit lines. That means then before trades, the balance sheets are all empty because the credit lines are contingent liabilities that are off the balance sheets. And then when trade occurs, there's already all these buyers who have arranged for credit line with the banks that are now going to draw down loans. And so that shows up as a liability on the part of the buyer. It shows up as an asset on the part of the seller. And the bank is now going to have both on the asset and the liability side, this V times L, because every credit line that gets drawn, that becomes a loan on the asset side, and it becomes a deposit on the liability side. And then the bank has to have a bunch of capital because there is a collateral constraint. And so that, so then you see already, because there's all these empty balance sheets here, this cost of holding assets is lower in this environment because you just get the liquidity when you need it, and then the balance sheet costs don't come otherwise. Okay? And so then again, we can derive by linking back to the macro quantities, we derive these costs. And this is the resource constraint. This is a resource constraint for the credit line dichotomy. And that basically has now welfare gains because all of these costs on the left-hand side are smaller. And it's basically that with credit lines, you avoid these precautionary holdings, which works as if there's higher TFP. And in particular, because there is these investment good producers are bad at holding assets, this is particularly good for them. So there is an additional kind of investment-specific technical progress. Okay, so that's the that's saying credit lines good. Okay, now what happens when there is the entry of a deposit-only intermediary? And so generally, we could imagine there's a new intermediary. It's got a different set of cost parameters. There's a maximal leverage, say phi star, and some asset management costs, kappa star. And our leading example, and this is the way that I'm going to talk about it now, is this is a CBDC with a central bank that offers deposits at marginal costs given by K star over phi star. Okay? But you can also think about it as the entry of Libra, which, or there's competition between different Libras. All right, so two sort of preliminary observations. One, I mean, this is going to help only if the new technology is better. That means that if this cost at which the deposits can now be produced is smaller than what we already have. That could come because of cheaper asset management or because there's better ability to commit, say, because it's the government. Okay. Now, second point, if banks offer only deposits and the new technology is better, then it's always great, okay? Because then what we're gonna have is that all the depositors are gonna migrate to the central bank, commercial banks disappear. Here, there's no loss from that because they provide no value beyond the liquidity provision. Now the CBDC can do the liquidity provision better, so great. Okay. Notice also that then investment actually will go up because now liquidity is cheaper, the resource goes smaller. Okay, And now the subtle question is, what if we have banks that not only issue deposits, but also provide credit lines, and there is the entry of the CBDC? Okay, so this is now, I can not only do the picture, because there's some subtle pricing issues that we will talk about. So now, when there are these two payment instruments to choose from, we got to talk about the buyers and sellers' choice of payment instruments. Okay? So the first observation is, if the bank deposits and the CBDC are priced the same, then the bank customer is going to be indifferent.
Martin, you have 3 minutes left, just a reminder.
Excellent. Yeah, thank you. Then, so generally there is kind of a potential price, there's a price effect, and there could also be a quantity effect, in the sense that households might choose to hold deposits now that the deposits are cheaper relative to the credit lines. What I'm going to do in this talk is I'm just going to focus on the case where after the central bank has entered, the buyers still use credit lines, okay, all of them. And that there's a condition in the paper that guarantees that, is basically saying that this that the predictability is relatively small. Okay, and in the paper we do sort of the other case as well, where there is a quantity adjustment as well. Okay, so now imagine that there's these two products, and what is the response of the commercial bank? Well, it's going to choose to still issue the deposits. It's better than equity, and then is going to match the higher interest rate that the people can earn at the CBDC. In order to remain profitable, what it's going to do is increase the price of the credit lines to break even. Okay, because it now has this higher funding cost, it's no longer profitable for the bank to invest in capital, so it's not going to do that. And so then we can look at what that means for the asset positions. And so it's actually helpful to start down here, where what happens after the trade. So because the buyers and sellers, there's nothing on the books here, because they just come in with credit lines, right? They continue using the credit lines. What happens after trade is they draw the credit lines, and the sellers get as an asset the loans, and then the bank is going to have the credit line as an asset on the books. But now the problem is that the banks, because it doesn't issue deposits against capital anymore, it can't keep all of the deposits on its books here. Some of them are going to migrate over here to the central bank. Okay, and that is an outflow from the banking system through the trade to the central bank. And the banks have to prepare for that. And they do that by holding upfront here some additional liquidity at the central bank. Okay? And so there's kind of two effects that happen. One is that there's this pricing of the credit line that is now different. That is now more expensive because of the competition from the deposits. And second, there's this liquidity holdings that the bank need in order to manage everything. And then when you compare the costs, and I'm not giving the full formula, but just the key inequality, then you have the result that the CBDC is going to improve welfare in this case, if and only if this equation holds, which means that the CBDC is sufficiently cheap, that the cost parameter is kappa star over phi star is sufficiently low relative to the cost of the private sector. And then that sort of translates into higher TFP, otherwise not. Okay? So it can happen here that because of this competition, their welfare goes down.
Martin, so can I ask you to wrap up? So we are.
Yeah, I'm almost done.
Right.
So kind of there's competition for deposits that distorts the price of the credit line, and this works not only with CBDC, but you could just have free entry of these deposit-only intermediaries. The mechanism is this externality among these different types of providers who jointly support the transactions that people do. Okay, and so in any hybrid payment system, like in a deposit-only system, you're going to have these extra costs. And so just to summarize, this is CBDC, even if the technology is better for producing deposits, is only beneficial if it's actually much cheaper to produce deposits than for the private sector. Okay, thank you.
Thank you very much, Mike. Then we can move on to the discussion. And I would like to ask Dirk to share his screen, and the discussant will be Dirk Niepelt. So he is a director at the Study Center Gertzensee and professor at the University of Bern. And yeah, so the presentation is up. Dirk, you have 10 minutes, and I also will remind you of 3 minutes before the time is out.
Thank you very much, Katrin. Thanks to the organizers for this great series and for having me discuss this very interesting paper by Martin and Monica. So the argument, I think, in essence, is that credit lines help economize on balance sheet length. CBC doesn't. And when balance sheet length is socially costly, so shows the emphasis here is on socially costly, then CBDC may be detrimental. And the interesting part that Martin emphasized at the end is really that nevertheless, you might have an equilibrium in which the firms or some of them coordinate into holding that stuff, CBDC, although in spite of these externalities that it creates, the outcome is worse for society at large. So I want to briefly focus on two aspects. The first one is that this is, and that's what I find interesting, it's sort of a diff and diff result, right? I mean, there's a difference between banking sectors with credit lines and without credit lines. And the argument is that this difference is affected when we introduce this CBDC. So it's like diff and diff, and I want to look at that for a second. And the second thing that I find very interesting is this last point, that you can coordinate into something which is worse than the previous equilibrium just because you have introduced CBDC. So for the first part, for the CBDC argument, let me first state what I think, at least according to my thinking about the issue, is sort of a simple way to think about neutrality, so an equivalence result. Let's forget about credit lines for a second and just think about CBDC versus no CBDC. So the first set of balance sheets here shows you a world in which we do not have CBDC. There are some firms that have some deposits on their asset side in the balance sheet, and there are some banks that issue deposits. The question is, what does it change? How does the equilibrium change in that setting when you introduce CBDC? And one way to think about this is that it does not change because essentially the firms could, rather than holding deposits, they could hold this new means of payment, CBDC, which would now be a liability of the central bank. What about the banks? Well, they have lost the deposits as a source of funding, but instead they either have reduced their reserve holdings at the central bank as a compensating measure, or alternatively, they have simply gotten new financing from the central bank. So the central bank here is a pass-through entity in the sense that we, the private sector, we hold claims vis-a-vis the central bank lends to the banks, and then in the end, the banks, don't really, for them, the world doesn't really change, of course, under some conditions. So that's sort of where I come from. That I think, well, CBDC doesn't really change anything. Of course, there's conditions attached to that, and there's many reasons to believe that this equivalence does not apply. Here's a list of some potential sources of equivalence failure. For example, CBDC and deposits might not be substitutable as a means of payment, which means that, for the firms, this is not as good a means of payment as this one or the other way around. Then, of course, you would not get equivalence. Or there's different resource costs attached to using either deposits or CBDC as a means of payment. Against, you would get non-equivalence. Or this refinancing of commercial banks by the central banks doesn't fly because there's collateral constraint, there's informational issues, et cetera, et cetera. Or, and that really gets to the heart of the story today, I think, is that gross balance sheet positions matter for some reason. And this could be the balance sheet length, because there are some asset management costs, as Martin and Monica assume, or there's some ownership structure issues. Some assets used to be owned by that guy, now they're owned by somebody else. That could also be a source of some mechanism of non-neutrality. Now, how do credit lines come into play here? I think Martin was very clear to show that, and now I do the other diff. Now I go from the diff regarding CBDC versus no CBDC. I now go to the diff regarding credit lines versus no credit lines. So what is the effect here? On the one hand, and again, Martin was very clear about that, credit lines basically increase velocity in the economy, right? Because on the one hand, the firms need to hold fewer precautionary balances. So these balances, these deposit balances are churned over more often than before because you just use them when you really need them. On the other hand, the holding period for that stuff is shorter. You only get them when you really want to transact and not already a month before that, as you would do with deposit accounts. You could also argue, and that's a side issue, that the ownership structure again has some consequences here. So that's clearly a change of credit lines versus no credit lines. There is an argument in the paper that credit lines also generate some complementarities, and there I'm not that clear exactly what the idea is. In the paper, Martin and Monica write that when a credit line is used, the transaction generates an asset that in turn backs deposits. This complementarity economizes on asset holdings and cuts cost by a factor of 2. Now, according to my reading, in that model, there's always, of course, one unit of assets backing a unit of liabilities. And if you compare the cost ratio in credit lines versus no credit lines, the cost ratio is totally orthogonal to the leverage ratio in that economy. So that seems not to be the key mechanism to get different costs. And also the 2 that is mentioned here is really just a reflection of the different holding periods. With credit lines, you have a shorter holding period than without credit lines. So I'm not that sure about this complementarity issue. But the main point that I want to make here under that heading is really that credit lines do not change the equivalence result per se that I lined out before. It's true that credit lines reduce the product, so to speak, of banks' gross positions times the holding period. That's clearly the case because of this higher velocity. But at each point in time, you could argue that whatever deposits are outstanding, either in the world without credit line or in the world with credit line, you could still substitute whatever deposits are there by CBDC plus central bank refinancing, as I highlighted in the beginning. Of course, subject to the caveats mentioned. But what I'm trying to say here is that these are 2 orthogonal things, right? You can think about credit lines on the one hand, and you can think about CBDC equivalence on the other, and the 2 are not necessarily tied into each other. You can think about gross positions under giving a role to credit lines, as we see clearly there is. You could also think about gross positions clearly undermining the CBDC equivalence result for reasons I highlighted before, but you can think about them differently. They're not necessarily coming together. In the paper they are, because essentially I think the assumption that whatever balance sheet you have, it has the same cost across all the agents in the economy is that nexus between these 2 assumptions. But that's not really necessarily built into the story per se.
Dirk, you have 3 minutes.
Yes. Okay, given that all these beautiful balance sheets that I spent hours creating in LaTeX, I will not show it to you. And let me get to my final 2 slides. So I think there's 2 ways to read the paper. The first one would be to say, this is a paper about the non-equivalence of CBDC. Then I'm not that sure, because the main argument really concerns the relevance of gross positions for credit lines versus no credit lines, as I tried to argue before. And such relevance need not per se imply that gross positions also undermine the CBDC equivalence. In the paper they do, as I said, but in principle I see them as 2 orthogonal arguments. So in some sense, if you want to argue that CBDC is non-neutral because of gross positions, you can write down a much simpler model, right? Without any of these credit lines, you don't need them whatsoever. You just directly go to the equivalence result I showed you before. You say, well, the balance sheets are longer, and that's it, right? So that's much more direct. So I think the more interesting way to read the paper would be to say, this is really about credit lines. And credit lines have this interesting beneficial effect because they lead to this cross-subsidization that Martin emphasized towards the end. And then some CBDC comes in and somehow things, explode. CBDC compromises them. That is sort of, I think, a much more exciting way to read the paper. It's sort of the opposite message of what we are used to hearing, namely that the banking sector, of course, creates value, but it might also create negative externalities that society has to bear in the end, like Chari and Phelan's paper, for example. Here it would just be the opposite somehow, right? I mean, the private sector creates these, the banking sector creates these positive externalities, and now the government comes in, the CBDC, and screws up, basically. That's sort of the message that they pursue, that they propose here. And then, of course, the empirical question is this really relevant? How big are these social costs and these cost differences in particular on balance sheets? And the theoretical question is, and I think Martin was open about that towards the end as well, you know, is it really CBDC that screws up here? Or what is it really? Because anybody who comes into the game here without this cross-subsidization business, but just with offering a means of payment deposits, would presumably undermine this beneficial equilibrium with cross-subsidization. So in the first place, before CBDC, do we actually have this equilibrium, this beneficial equilibrium that CBDC can kill, or doesn't that even exist? Thanks very much.
Thank you, Dirk, very much for the discussion. So I will next then ask Martin to respond to the issues that Dirk has raised. And as Monica is on the panel as well, she may also want to come in. Thereafter, we will commence with our Q&A session. And therefore, I would like to invite you to post your questions in the Q&A areas. And I also would like to invite panelists to ask questions. So yeah, maybe you can unshare your screen, and then we can start with Martin and probably Monica responding to the discussion, and then I will collect questions.
Right. So great, Dirk. Thanks a lot. That was really, really useful. Yeah, and so let me first say, so we agree about the readings. So the way you read it, that's also how it was intended to be written. We think it's not primarily about there's no equivalence result. In fact, I mean, the characterization of the Equilibria works with a planar type problem, and it's very instructive to think about different systems that lead to similar allocation. So the main thing that we learned from doing this is that it is for judging whether all of these innovations, not only CBDC, but also Libra, et cetera, and actually looking back also money market funds, as they compete with banks, whether these are beneficial things, requires thinking about credit lines as well, because those are important parts of the payment system. And there is this relationship through the bank's balance sheet between these things. So that's what we think is the message. Now the next step, many next steps should be taken to make this quantitatively more evaluate this. And I think that's kind of exciting. One has to think harder about what are exactly the flows of payments between different types of instruments, right? For example, if all of this, let's say there was some segmentation of the market for payment instruments where sort of mostly one group of people just uses deposits and others use use credit lines and deposits together, then maybe the cost is lower, etc. So so using this framework and the forces that we've outlined, I think one could make the model richer to get more of these empirical things, and that's something that I think should be on the agenda. Good. You want to add?
So if you're done with your response, then I would invite participants to ask questions. So at the moment, I don't have any questions in the Q&A, and I'm also not seeing somebody raising their hands. So maybe let me start. Of course, you may know that the ECB is very eager in starting with looking at CBDC and trying to figure out what CBDC would mean. So provocative issue. So I wasn't quite sure. I think Dirk alluded to that. There is an issue, of course, with the funding of the banking sector, and there might be frictions. So you are just assuming that it goes to the central bank balance sheet. So if there are frictions, I guess your results will be even worse as regards the welfare effect of CBDC. Yeah? So if the central bank accepts only very safe assets, whereas the bank accepts loans that are have some credit risks and are riskier, then you would get another friction, and I guess your results would be even less favorable.
Right. Yeah. Okay. So yeah, that's a good point. That connects also to the paper by Keister and Sanchez, where so in our we took the approach here to say the only thing that banks are good at is liquidity, right? And there is no cost of raising equity, and the banks are not good at funding particular types of firms. And so that shuts out all of the potential disadvantages of this competition with CBDC that other papers have looked at. Is just about the liquidity. And so, but you're right. I think especially for a quantitative investigation, it'd be useful to combine these things. I mean, our model is sort of geared, would only work in a world where all the banks are very large yet competitive, and everything is super securitized, so that there's no friction on the asset side, which is a stark world. And there are these other things, both cost of raising equity and sort of advantages of banks lending to particular customers. That's something that's probably relevant. And so to quantify the relative importance of these things, that would be interesting to do.
Yeah, thank you. So Bruno has a question.
Thank you very much. Thanks a lot for this great paper and this great discussion. It seems that from the paper, we're learning something about central bank currency. We're learning something about what happens when firms can have accounts at the central bank. But I didn't get what we learned about central bank digital currency. It seems that the technological aspect of the currency is not really the focus of the paper. Am I wrong?
Yeah, so I guess that's all swept up in this cost parameter. And I would say the fact that there is now digital creates more of a potential that the new entry, either from the central bank or from some other deposit-only intermediary, is actually produces deposits more cheaply. Okay, but it's in this very reduced form way that it shows up. Yeah, that's right.
Yeah, I think Todd has a question.
Yeah, Martin. So I was thinking, given that we live in a world where there are money market mutual funds, and if we think of CBDC, maybe it's a lower cost way of providing deposits, but only a little bit lower, not wildly better. Could I interpret your model as kind of saying either we should adopt CBDC or we should ban money market funds? That is, if one is desirable, the other is desirable? Yeah,
so that exactly. So
okay. And do you have a sense?
Sorry.
Go ahead.
Yeah, just, I mean, there's sort of an interesting, there's sort of two ways to use the model to think about money market funds, I think. One is to sort of think of the 70s when they started, right? Mm-hmm. Where the situation, the way you can think about it through the lens of the model is that there was a cost of producing deposits that increased basically because of the inflation and regulation queue. And the money market funds could come in to provide cheaper deposits, but the banks were not allowed to match. Right. Okay, so that's different from the model right now, but the model could be used for that. And then in the model, what would happen is that you get massive disintermediation, and it's very costly for society. Right. Now, the current situation with money market funds, the way I look at it from looking at the empirical literature is that there are these guys, they came in for historical reasons because of regulation. It's not clear what the cost advantage currently is, because I mean, when we see banks offer money market deposits accounts, they can kind of replicate whatever these, I mean, the custodian banks can kind of replicate what the money market funds themselves are doing. Okay, and so then that's basically, then I would say exactly what you said. So right now there is not obvious cost advantage. It's just creating this competition. It's making it costlier for liquidity management of the economy as a whole. That's the argument of the paper. And so then that's not there's no point in having them. That's what it is.
Okay, thanks.
Yeah, I would have a question to Bruno, which is not really a question to the paper, but it's something that I have been hearing very often and that I'm struggling a little bit with. It's always this technology question. And of course, as Martin said, so as a monetary economist, you put in some cost parameter and that's it. And so you don't think about whether it's a token or whether it's an account or whatever. And so you say, well, there is a cost and we have. So I was wondering, do you have ideas how to go about modeling technology choices, whether it's distributed ledger or token or accounts, beyond going for a cost parameter that might differ between technological choices?
I wish I did, but at least there is some advances which have been done in trying to model blockchains. You know, one of the possible ways in which central bank digital currencies would operate would be with consortium blockchains or even centralized blockchains. So at least we could try to build in that direction to try to understand the technological infrastructure for central bank digital currencies.
Can I say something on that? I mean, I would put the focus on the use. So that's what my reading of Kister and Sanchez is. That's what they do. For them, digital means you can make certain payments with that instrument, but not others. Right? So they have different vendors. You know, you can settle with different instruments. They have several instruments. They have physical currency, and those are not very good if you want to buy something online. So the way they model it is, you know, they have different liquidity properties depending on who accepts it. So that shifts, you know, that's an answer. You know, it shifts it to the use rather than the production side. I think the production side is harder to make a case that it matters a lot for these high-level questions. Like, you know, we've been doing monetary economics for many years without thinking about clearing the Fed funds market. So it's not obvious to me that those details will matter for the high-level questions that these guys are talking about. But
well, you know, for example, let's take one concrete example. Otherwise, it's a bit difficult in general. You know, if you think of international transfers of funds, this is something that currently is not digitized. So it works with old technologies, you know, banks calling each other and using SWIFT to transmit messages. And this is really costly. It takes a very long time and it's very inefficient. And one could think of having a blockchain, a consortium blockchain, to make this process more efficient. So it's not exactly the same question as what Martin was talking about. I realize I apologize for answering a little bit beside the question, but I think there are ways to try to model the technological improvements associated with digitization.
Well, this seems to have broken the ice. So there are a number of questions now from the Q&A. And I'm going to summarize a few ones to have them jointly. So there is George Ponce asking how the results affect if one considers that a CBDC could foster competition in payment, cost reduction, and financial inclusion. Then there is the question whether a CBDC inadvertently could introduce a credit constraint in the economy, given that's under control of the central bank. And related to this blog is also a question that's referring to narrow banking. So whether these arguments also relate to narrow banking. So maybe you can answer these questions.
Yeah, great. Okay, so first on competition. So yeah, this model, everything's perfectly competitive. It just zeroes in on the technological features. There's other work by starting with the work of David Andolfato that has argued that, you know, undercutting commercial bank market power in the deposit market is something that CBDC would be a force that makes CBDC improve welfare. That is probably an important feature, given the measures of market power that we have. In our context, there is this additional question of market power in provision of credit lines. And so that is present. So if you look at capitalization of these credit card companies, which you can think of as, I mean, those are not guys that have credit line drawn loans on their books, but rather they just provide the technology to make this all happen. There's network externalities there. There's large rents, and so that is something that's an additional force that we want to think about it. And roughly, I mean, the way this would work is that if the banks get taken to the cleaners by kind of these service providers with network externalities, then these synergies between deposits and credit lines that we discuss are weaker because there's an additional imperfection there in the credit line market. That I think is something that very interesting to talk about, and that also actually goes to the question of the role of technology, because you might imagine, in a digital world, the way that market power works is different. I think that's an important question for the future. Then about the overall credit constraint, so that in our model, because of the banking sector is really quite, the financial frictions are just this collateral constraint, and you can always raise equity. And so there isn't an overall credit constraint for the economy. In fact, the optimal capital stock is not affected by some credit constraint directly. It only comes from liquidity demand, the effects on that. And then, so interesting about narrow banking, yes. So, I mean, you can read our results about deposits only versus credit lines as a result that says narrow banking is not good enough because it doesn't provide this flexible payment instrument that is credit lines that has an advantage in our model. Okay, obviously we do not have other features of narrow banking that have to do with financial stability that would maybe provide a counterforce, but there is a force here that says narrow banking is not good enough. We want on the asset side of banks loans drawn from credit lines.
Yeah, thank you. So I have another question from James McAndrews. So Jamie, you have your microphone unmuted. You can talk.
Thanks very much. Great paper. Thank you a lot. And I'm still trying to kind of understand the market structure as you see it. It seems that all the asset management has been moved over to money market mutual funds, and banks consist solely of these credit line. They create liquidity solely via the credit line in your main thing. And I'm wondering, do you think the credit lines are the marginal source of deposits in the economy, or in practice? And what I'm having difficulty reconciling is in practice we see, for example, as you were saying, the credit card banks are separate from most deposit banks, and they fund themselves via asset-backed securitization. And the vast majority of backing for deposits is some sort of asset management by banks, a lot of that consisting of reserves, which pay an interest rate. So and we get into kind of the David Andolfato market structure, market imperfection point of view. But I'm wondering, have you thought about a bank that does combine the asset management and the lines of credit together, and how because what I'm thinking is that if the rate of interest is set by the central bank, then that's kind of that's the base rate of interest. So there's no inefficiency. Credit line borrowers would be willing to pay the safe rate of interest plus the benefit of the credit line, and so it wouldn't detract from the liquidity created by the credit. Thanks.
Okay, yeah, great. Yeah, so there are a couple of interesting points there. So first about so the way I think about our the model without the entry by anybody who's doing deposits only, that would be, then the banks optimally combine both activities. There's some asset management and there is some credit line provision, right? And I think, I mean, roughly speaking, in a system where there was universal banking unfettered by regulation in the 1970s, like it was in many European countries, it sort of looks like that. And then the US is kind of special because it's got these money market funds extra. And then the CBDC, I view it as sort of, okay, now in all these other countries, we're going to do something similar. That's kind of the way I think about that. Okay, and then you raise this interesting question about interest rate policy. This is something that we're actually working on. So what we haven't thought about fully is there some interest rate policy that can strike an interesting compromise between benefits of CBDC just from having cheaper costs and not generating this externality on the commercial banks. And this is so I know if sort of leverage is sufficiently high, that's not true. In fact, so the optimal, then you can show that the optimal policy is then one where you just don't do the CBDC under the conditions that I showed. But there may be more generally some room for showing additional results that we haven't done it yet. But that's an interesting question.
So we're coming close to the end of the seminar, but there are still two open questions. So I read the shorter one, which is by Angela Reddish, and she asks about the empirical significance of the result and how you would think about assessing them. And the other question is on regulation by Larry Wall. So he is unmuted, he can ask there, but I would also ask you to keep your question short.
Okay, this is as much an observation as anything, because a comment had been made, money market funds aren't serving any purpose. Well, perversely, we're creating a purpose for it in the US. With central bank quantitative easing greatly increasing the amount of reserves, we're also increasing the amount of deposits. That wouldn't be a big problem if the commercial banks could costlessly hold reserves, but post the global financial crisis, we've imposed a whole bunch of costs on holding reserves or increasing the balance sheet. So now the combination of money market funds and the central bank reverse repurchase programs provides a way to deal with this increase in reserves without sticking the banks with the increase in their balance sheet and having to bear those regulatory costs.
Okay, great. Yeah, thanks. So Angela, first on the, yeah, so I think, so the model basically says how that these externalities that are at the center of the analysis should show up in prices, the relative prices of the different instruments. Moreover, we would expect those to depend on the kind of the patterns of payment flows among different participants. And so I think for an empirical approach, we want to think about sort of add some more detail on who is using which payment instrument and at what prices. That's roughly the way this would go. And this may mean making the model a little bit richer and having different types of agents that partly maybe use things as imperfect substitutes. That this model is quite stylized, but that is the direction I think which we will take this. And then, so Larry, yeah, so I mean, there is, I always think that the US monetary and banking system is the most complicated because it's got all these different regulations that lead to private sector responses that that in other contexts we don't really have. And so I agree that to really understand the details of the trade-offs in the US as they occurred historically and or now, various other government peculiarities have to be taken into account. So that I'm on board with that.
Thanks a lot, Martin. So this ends the Q&A session. I would like to thank the presenters and the discussant, and then I would hand back to Jonathan to close the meeting.
Thank you again, Martin, Dirk, and Katrin, as well as all of you for participating today. You'll be able to find the slides and the link to our YouTube video on our website, cbndc.net. We hope that you will join us again next month on May 28th, when the IMF will host our next session. Until then, I hope you have a nice weekend.
Thanks, everyone.